Welcome to Money Matters, the podcast where we break down the world of wealth and investment management one chapter at a time. I'm your host, and today we're diving into Chapter 1 of the International Certificate in Wealth and Investment Management, all about the financial services sector. So first things first, what exactly is the financial services sector, and why does it matter?
Think about this. Every single day, the foreign exchange market, where currencies are traded, sees more than $6 trillion change hands. $6 trillion. Every day. And the total value of shares listed on the world's stock exchanges? That exceeded $109 trillion as of December 2023. These numbers are almost incomprehensible, but they tell us one thing very clearly. Financial services is one of the most powerful forces shaping our world. And it's not just about big numbers. The financial services sector touches every part of the economy. From a farmer in Kenya using a mobile phone to receive payment, to a tech startup in Silicon Valley raising millions from venture capitalists, to you or me putting money into a pension for retirement.
Now let's talk about what the financial services sector actually does. Because it has three core functions, and understanding these is key. The first is the investment chain. This is the link between people and organizations that have money and those that need money. Think of it as the plumbing of the economy. Investors, like pension funds, insurance companies, and individuals, have capital they want to grow. Governments and businesses need capital to operate, expand, and innovate. Financial services acts as the pipeline connecting these two groups, and the more efficient that pipeline is, the better resources are allocated across the economy, boosting productivity and driving growth. The second function is managing risk. Life is uncertain, right? Businesses face currency fluctuations. Homeowners worry about floods or fires. Companies worry about interest rate changes. The financial services sector provides tools to manage these risks, primarily through insurance and derivatives. Derivatives, things like futures, swaps, and options, sound complex, but at their core, they're just financial instruments that allow companies to hedge against things they can't control. And the third function is payment systems. This is the plumbing of everyday commerce. How does money move from your bank account to a merchant when you tap your card? How do international companies settle trade deals across borders? Systems like SWIFT, the global financial messaging network, make this possible. And increasingly, technology is expanding access to payment systems in parts of the world that previously had none. In Africa, for instance, mobile phone banking has brought millions of previously unbanked people into the financial system. Okay, so we understand the why. Now let's look at the who, the main players in the financial services sector. First, a useful distinction, the difference between wholesale and retail markets. Wholesale markets are essentially the business-to-business side of finance. Companies, governments, and large financial institutions raising enormous amounts of capital, trading currencies, managing risk with complex instruments. That's wholesale. Think equity markets, bond markets, forex, derivatives, and investment banking. Retail markets, on the other hand, are the business-to-consumer side. That's your high street bank, your home insurance, your personal pension plan, your investment ISA. It's finance for individuals and small businesses. Now, here's the thing. In practice, many large financial institutions straddle both worlds. A giant bank like HSBC or JP Morgan Chase might have a retail banking arm serving everyday customers, and a wholesale investment banking arm advising on billion-dollar mergers. Let's look at the key institutions one by one. First up, retail and commercial banks. These are the banks we're most familiar with, the ones with branches in every town center and apps on our phones. They take deposits from customers, pay interest on savings, and lend money out at a higher rate. That spread is how they make their profit. Traditionally, retail banks served individuals, and commercial banks served businesses, but those lines have blurred significantly. Then there are savings institutions, known as building societies in the UK, cajas in Spain, and other names around the world. These are typically mutual organizations, meaning they're owned by their members, the depositors and borrowers, rather than shareholders. Over the years, many have converted into traditional banks through a process called demutualization. Now, here's where it gets interesting. Challenger banks. These are new generation digital banks. Think Monzo, Revolut, Starling, that have disrupted the traditional banking model. No expensive branch networks, fewer legacy IT systems, just sleek apps and competitive rates. And then there's peer-to-peer lending. Platforms that connect savers directly with borrowers, cutting out the bank entirely. Savers often get better returns. Borrowers often get lower rates. The platform charges a fee. Simple. There's also a growing phenomenon called shadow banking, non-bank institutions providing bank-like services, but outside traditional regulation. From money market funds to pawnbrokers, regulators worldwide are watching this space closely.
Next, let's talk about investment banks, which, despite the name, are very different from the banks we just discussed. Investment banks don't take deposits from everyday customers. Instead, they're in the business of helping companies and governments raise money, structure deals, and navigate complex transactions. If a company wants to float on the stock exchange, that's an IPO. An investment bank advises them and underwrites the offering. If two companies want to merge, investment banks are in the room negotiating. Beyond advisory, investment banks also offer trading services, treasury management, and investment management for large institutional clients like pension funds and hedge funds. Major investment banks include names like Goldman Sachs, Morgan Stanley, and Deutsche Bank. Most of them specialize. Very few offer every possible service. And notably, after the 2008 financial crisis, regulations like the Dodd-Frank Act in the US, specifically the Volcker Rule, restricted investment banks from taking certain trading risks with their own capital.
Now let's talk about two other crucial players: pension funds and fund managers. Pension funds are exactly what they sound like. They collect contributions from employees, and sometimes employers, during a person's working life and invest those funds to provide an income in retirement. Because pensions are long-term commitments, often stretching over decades, pension funds tend to invest in a mix of shares, bonds, property, and cash. The sums involved are staggering, we're talking trillions of dollars managed by pension funds globally. Fund managers, also called asset managers or investment managers, are the professionals who actually manage these pools of money. They make decisions about which shares to buy, which bonds to sell, when to rebalance a portfolio. Fund managers can be independent firms or divisions within larger banks or insurance companies. There are three broad types. Institutional fund managers work for large organizations, managing pension fund money or insurance fund money. Mutual fund managers operate funds available to the general public. These are things like unit trusts or OEICs in the UK, or mutual funds in the US. And discretionary fund managers, sometimes called private client managers, handle bespoke portfolios for wealthy individuals.
There's one more key player we should mention, and it's one you might not have heard of: custodians. Custodians are specialist banks whose job is to keep assets safe. Think of them as the vaults and admin teams behind the scenes. When a fund manager buys shares, someone has to actually hold those shares securely, arrange settlement, collect dividends, process corporate actions, and report back to clients. That's what custodians do. Major global custodians include BNY Mellon and State Street. They operate in markets around the world. Some custodians focus on specific regions, like HSBC Securities Services in Asia and the Middle East, and local custodians handle specific country-level custody needs tailored to local regulations. Without custodians, the entire financial system would struggle to function.
Now let's zoom into one of the most relevant areas for anyone working in or aspiring to work in finance: wealth management. Wealth management is about providing comprehensive financial services to individuals, helping them manage, grow, and protect their wealth in line with their personal goals and risk appetite. Wealth management has evolved significantly. It used to be that financial planning and investment management were entirely separate fields. Today, they're integrated. A wealth manager might help a client with investment portfolios, tax planning, estate planning, mortgages, insurance, you name it. The market is typically segmented by wealth levels. Mass affluent individuals have investable assets over $100,000. High net worth individuals, or HNWIS, have over $1 million. Very high net worth individuals have over $5 million. And ultra high net worth individuals have over $30 million. According to Capgemini's World Wealth Report, assets managed for HNWIS alone exceeded $86.8 trillion. And that number is on course to hit $100 trillion by 2025.
Who actually provides wealth management services? There's a range of players. Financial advisors provide holistic advice covering budgeting, savings, investments, pensions, and tax. Some are independent, meaning they can recommend products from any provider. Others are restricted to a specific range of products. Commercial banks offer wealth management services to their broader retail customers. Stockbrokers and dedicated wealth managers manage portfolios directly, often on a discretionary basis, where they make decisions without needing the client's approval for every trade, or an advisory basis where they recommend and the client decides. Private banks serve the wealthiest clients, typically HNWIS and above, with bespoke, personalised services. Private banking goes beyond investment management to include everything from estate planning to lending against investment portfolios. At the very top end are family offices, dedicated advisory and management structures for ultra-wealthy families. A single family office serves one family. A multi-family office serves several, allowing for cost sharing. These are serious operations, sometimes with dozens of staff managing every aspect of a family's financial life. And then there are private investment offices, independent firms, often structured as partnerships that manage investment affairs for a select group of ultra-wealthy clients.
There are also 3 modes of portfolio management that are important to understand. Discretionary management means the portfolio manager has authority to make investment decisions within agreed parameters. No need to call the client before every trade. This suits busy clients who trust their managers. Advisory management means the manager recommends, but the client decides. The client is in the driving seat, they just have an expert co-pilot. And execution only, the simplest and cheapest option, where no advice is given at all. You decide what you want to buy or sell, and the firm just executes the trade. Perfect for confident, experienced investors who know exactly what they want.
Finally, let's talk about 2 game changers reshaping wealth management: platforms and technology. Platforms are online portals, used mainly by financial advisors, that provide a centralized view of a client's entire investment portfolio. They make it easier to buy and sell investments, manage custody of assets, and provide reporting. Many platforms are also now available directly to retail investors. And then there's technology more broadly. Fintech, financial technology, is disrupting almost every corner of wealth management. Clients today expect digital access to their portfolios, real-time data, and seamless communication. COVID-19 dramatically accelerated the shift toward digital interactions. One fascinating development is robo-advice, the use of algorithms to provide financial advice without a human advisor. A client enters their financial details, the algorithm assesses their risk profile and goals, and recommends a portfolio, usually built around passive index funds or ETFs. Robo-advisors are cheaper than traditional advisors, available 24/7, and perfectly suited to investors with straightforward needs. They must still be registered with financial regulators and comply with the same rules as human advisors. Of course, technology brings challenges too: cybersecurity threats, data privacy concerns, and increasing regulatory scrutiny. But for firms willing to embrace digital transformation, the rewards, efficiency, deeper client engagement, competitive advantage, are significant.
So let's quickly recap what we've covered today in Chapter 1. The financial services sector serves 3 core functions: the investment chain, risk management, and payment systems. It's divided into wholesale markets, serving businesses and institutions, and retail markets, serving individuals and small businesses. The main players include retail and commercial banks, savings institutions, investment banks, pension funds, fund managers, and custodians. Each plays a distinct but interconnected role. Wealth management is a broad, evolving field, serving everyone from the mass affluent to ultra-high net worth families, through financial advisors, private banks, family offices, and portfolio managers using discretionary, advisory, or execution-only approaches. And technology, from platforms to robo-advice to mobile banking, is transforming how financial services are delivered, for better and for worse.
That's it for today's episode of Money Matters. Whether you're studying for the CISI Certificate in Wealth and Investment Management or just expanding your financial knowledge, I hope this gave you a solid foundation in understanding the financial services sector. Next episode, we'll move on to Chapter 2, Industry Regulation, exploring how financial markets are overseen, why regulation matters, and what happens when it goes wrong. Until then, keep investing in your knowledge. Take care, and I'll see you next time.